So I'm going to talk about, as I mentioned before, our topic for today will be the factors that move the stock market. And I want my focus for today to be on inflation and interest rates because these are the major factors that have been affecting the stock market in 2022, and they're going to be the major factors that are going to determine the direction of the stock market in 2023. Okay, so when we talk about factors that that move the stock market, we have many factors. We can't tackle all of them today. So we have factors like the normal factors, supply and demand. We also have investor sentiment. Are investors optimistic about the direction of the economy, direction of the stock market? We also have geopolitical risks. Let's say something like the Russian-Ukraine war. So a moment when we have a lot of geopolitical risk, then we'll see a lot of investors sort of shifting their portfolio and looking for safe havens. Yeah, so these are some of the factors that will affect the general stock market. We also have factors that affect individual stocks. So for individual stocks, we have factors like earnings. For the guys in our WhatsApp group, you have seen most of the time when a company reports good earnings, the stock will perform good, will perform well. And when a company has negative earnings, the company will tend to perform. And that's why it's always important when you're investing. Let's say you are a short-term investor, it's always important to be in touch with the earnings report of companies. I'll send you a link of a website where you guys can follow up on the earnings of companies. Let's say the companies that are releasing earnings today, and that would be good. So I've talked about earnings. You also need to look for key management changes. Let's say if a company is changing the CEO, that also affects specific companies. You also need to be on the lookout for news such as mergers. Let's say a company is merging with another company. That also affects the share price in the short term. Another factor, so I've talked about key management changes, I've talked about earnings report, and I've also talked about mergers and acquisitions of companies. Okay, so another thing that I've seen that really moves the market is this, mostly in the healthcare companies, the biotech companies. Let's say a company has been doing some research on a vaccine, like the Moderna vaccine yesterday. So when a company reports positive results of a vaccine, let's say they did some trials and the trials are positive, then most of the time you can watch even the market in pre-market trading, you see that the company is trending and the company is performing well. And when it comes to the market open at 5:30 p.m. Kenyan time, you'll find that the stock will tend to perform well. So most of the time, when you go to, well, let's say you are Yahoo Finance or other websites and look at trending stocks or companies that are performing well today, you find that most of the time, one of the companies is usually a healthcare company or a biotech company that has had some positive reports on their vaccine or another research they were doing. Okay, so these are some of the major news or rather factors that affect individual stocks. We also have things like supply, production, sales. So like when I think it was last week, Tesla announced that they were cutting sales, they were cutting the prices of their cars, of their EV vehicles by 20%. Basically this is a sign to investors that the company is facing demand issues. Then most investors will tend to have a negative outlook of the company. So, or if you can remember, I texted that on our WhatsApp group. We saw the company lose close over 5% on that day after they announced that they were going to reduce the prices of their EV vehicles by over 20%. Okay. Another thing you need to look at for individual companies, you can also look at things like job cuts. So you find that companies, like what we've been seeing right now, most tech companies are doing a lot of job cuts. And when it comes to job cuts, this is mostly done to cut costs. And when it comes to cutting costs, we'll see that on the short term, most investors will react positively to a stock that is trying to cut its cost. Okay. Let me talk about now the general factors and that affect the stock market. And let me start by mentioning that we have major news that affect the stock market, pardon me for that, rather major reports that come out on different times, different times of the month, and these reports generally signify, or rather are a metric of the health of the US economy, hence affect the investor sentiment. And I'm going to expound more on that. So I want my focus for today to be inflation. And for those of you, I know most of you guys can define inflation. So basically, inflation is the broad and gradual increase in the prices across an entire economy. And let me just mention that if you don't understand something, raise your hand and I'll explain. Okay, so what happens is when prices rise, inflation will tend to lower the purchasing power of money. So what happens is when inflation is high, okay, major central banks. So let me mention the major central banks we have. For the US, we have the US Federal Reserve, which is normally referred to as the Fed. We also have the ECB, which is the European Central Bank, and we also have Bank of England, which is the BOE. So when inflation is high, the central banks will tend to use monetary policy tools to try and control inflation, because they're sort of like they're in charge of controlling inflation in an economy. So moderate inflation is necessary to sustain economic growth. Okay, so how do we measure inflation in a country? So let me take the US as an example. So around the middle of every month, the Bureau of Labor Statistics issues its Consumer Price Index, commonly known as CPI. I know you guys, the guys on our WhatsApp group, I told you about CPI last week. So last week, that's when we had the latest CPI, US CPI for December. So CPI, putting it simply, is basically the US inflation data. It's considered an indicator of inflation and one of the most important economic indicators, closely watched by investors, and most importantly, the Fed, which is in charge of monetary policy, who then use it to determine interest rates during the Federal Open Market Committee meeting. Okay, don't worry about that. I will talk more about that. Okay, so let me talk about investors and the Federal Reserve. So for investors, the effects from inflation reduce the perceived present value of future cash flows from stocks. So basically, stock prices, at least in the short term, not long term, in the short term, are largely a function of investor expectations, what I mentioned earlier as investor sentiment. And if they perceive the present value of future cash flows to be lower because of high inflation, they will act in a way that makes them lower. As a result, stock prices will drop. Okay, so generally what I'm saying is high inflation is bad for the stock market, and that is one of the reasons why for the guys who have been attending the webinars, I told you that 2022 was the worst performance of the US stock market since 2008. Okay, and this is because we had the highest inflation level, reaching close to a high of I think 9.1. Yeah, so as I mentioned, a rise of inflation will force the monetary authorities, the banks I've just mentioned, the Federal Reserve, the Bank of England, the ECB, to raise interest rates. So that's how they control monetary policy. They control inflation by using monetary policy tools, which are interest rates. So please know that if you have a pen, you can write. High inflation will cause the banks, or rather the central banks, to raise the interest rates. When interest rates rise, the stock market will fall. Okay, so let me explain. Why does the stock market fall when interest rates are raised? Okay, so what happens when interest rates are raised? Investors will tend to rebalance their portfolio. And what do I mean by this? So you find that most investors have sort of a ratio of the securities they hold in their portfolio. They'll have stocks and bonds and maybe other asset classes, index funds and all that. But let me talk about a portfolio with stocks and bonds. So when interest rates are high and inflation is high, investors will tend to shift their portfolio to hold more bonds, or rather government debt securities, as compared to stocks. And why is this? So this is because the risk to reward ratio will change. And how does this change? Let me give you an example. Let's say a debt security, let's say the US Treasury bond, has been offering a return of 6%. Yeah. And this is determined by the interest rates. But now, when the interest rates have been increased, let's say the return is now at 8% due to the increase in interest rates. So let's assume a situation where the stock returns will remain constant, let's say at 15%. The risk to reward ratio has gone down from 2.5 times to 1.9 times. So basically, as the interest rates keep on increasing, the risk to reward ratio keeps dropping. And this is one of the major reasons why investors will tend to shift their holdings from more equities to, from equities to debt. Okay, so basically, as inflation rises and the major central banks continue to hike interest rates, investors will tend to restructure their portfolio to hold more debt assets, e.g., government bonds, and reduce their holdings in stocks. Okay, so the historical trend shows that the stock market returns are relatively lower during periods of rising inflation. I think that explains the correlation between inflation, interest rates, and the returns of the stock market. Okay. So let me explain about now the whole CPI, FOMC, NFP in a more summary manner. Okay. So what's happening in our economy right now, or rather in the US economy right now, because we are talking about the US stocks. So for the major part of 2022, we saw increasing inflation. So inflation was high, and the sentiment overboard is that inflation increased due to the increased rate of printing of money that the Fed did in 2020 during the COVID, to try and cushion the citizens from the effects of COVID-19. So the more money we have in the economy, the more money is being printed, printed and added into the economy, then we have high inflation. And the effects were felt in 2022. So when we had high inflation generally, from what we have learned so far, the Federal Reserve then decided to hike interest rates. Actually, this was the most aggressive interest rate, interest rate hike we have seen in the recent past. And what happens, as we have learned, when the Feds continued to raise their interest rates, investors generally shifted their portfolios from stocks, so they sort of liquidated their stock holding and shifted their capital to US government debt securities, like the 10-year US Treasury bond, or rather the 2-year US Treasury bond. Okay, so that's one of the factors. And so I've talked about CPI. So let me talk about the labor market. And the labor market, a key indicator of the labor market is the NFP data, which is the non-farm payroll data, which comes out every first Friday of the month. So these are some of the data points that are looked at by the Feds to be able to decide their interest rates. And for investors also look at the data to be able to get a general sentiment of where we are as an economy and where we are headed, where the market is headed. So the NFP data, so I've talked about CPI. I hope you guys are good with that. The Consumer Price Index. That's a key indicator of inflation. Let me talk about NFP, the non-farm payroll. This is the US jobs data. It shows the number of new jobs that have been created in the US stock market in the previous month. So every first Friday of the month, we get the jobs data from the previous month. And why is it important? The reason why NFP is important, it's a key indicator of the health of the US economy. Basically, how many jobs are being created in the market, and why does the Fed use this data to decide interest rates? So the Fed is is not majorly concerned about the new jobs, okay? The Fed is mostly concerned about the wage rate growth, okay? So the major target of the Fed is to keep the wage rate growth in basically to control the wage rate growth. We don't want to see a lot of wage rate growth. I mean, wage rate growth, pardon me for that, because this tends to be a catalyst for inflation. The more wages are increasing, we're going to see more inflation because guys will be more willing to spend money, okay? And according to the laws of supply and demand, more demand, then prices will tend to increase. So the major focus for the Feds when it comes to NFP is to look at the wage rate growth. And that's why I told you guys the NFP is one of the three major data points that you guys need to follow when investing to make, just to get a touch of the general market. So I've talked about CPI, I've talked about NFP. Let me talk about the FOMC. The FOMC, now this is the most important data. The FOMC data, or rather the FOMC is a committee sort of. Actually, the word stands, the whole word is Federal Open Market Committee. So what's the work of this committee? This committee meets, I think, 8 times a year to decide on the interest rates of the US. And knowing what you guys know now about interest rates, then I think you guys can understand why this committee is important and why the decisions they make have a huge influence on the direction of the stock market. So the next FOMC meeting we have is around towards the end of January to the beginning of February. And this will be very important because for the major part of 2022, we saw the Federal Open Market Committee, or the Feds, raise interest rates by 75 basis points. And now the last hike they did in December was 50 basis points. Now we expect the Feds to hike the rates, pardon me for that, to hike the rates by 25 basis points. So basically, from what you guys can see from just the data we have, the consensus in the market is that the Feds have started to slow down the hike of rates, and which is a key signal, sort of a signal that the market direction is about to shift, because as I've told you, higher interest rates, negative for the stock market. Lower interest rates, positive for the stock market, okay? And I think I mentioned this in the previous meeting. The shift between these action of the Feds, basically, when the Feds are hiking interest rates, the term used is aggressive, or rather quantitative tightening. And when the Feds are lowering interest rates, the term used is quantitative easing. So the shift between the two, between quantitative easing and quantitative tightening, is what we call a Fed pivot. So the moment we see the FOMC sort of going slow on the hike rates, then what the investors will tend to assume is that we're about to see a Fed pivot. We're about to see a Fed pivot from what we have been having, which is aggressive monetary policy, a lot of quantitative tightening, to a more expansionary monetary policy, which will then cause the stock market to go up and see a shifting the direction of the general market. Okay, but for now, I think it's more of hope from the investors, and I think what we can do is wait for the decision of the Feds, which will be early Feb. So I'll update you guys on all our groups on the decision. But the estimates, or rather the projection, is that we'll have a 25 basis point hike. And from there, around Q2, Q3, we'll have a shift in policy. And there's a high chance we might see a recession in between, because it's usually hard for the Fed to tighten monetary policy without causing a recession. So it's important, we begin to see, can we see a soft landing where the Feds will be able to maintain inflation at a low level without causing a recession. Okay, so I'll keep you updated on that. So let me talk about now, how do we invest in such an environment? How do you invest in a high inflation environment, or rather, how do you invest in an environment where we're having a rise of interest rates? So basically, growth stocks tend to be very sensitive to rising interest rates, and when we're having a high of rates, it's important to shift your portfolio to reduce the growth stocks in your portfolio and go for more value kind of investing. So let me talk about inflation resistant stocks. Okay, so certain stock market sectors have performed relatively well during periods of elevated inflation. So since 1973, the energy stock has been a top performing sector during periods of high inflation. And this held true in 2022, because you guys can remember when I sent the 2022 summary, the energy sector had an annual return over 60%, even as 9 out of the 11 sectors in the S&P 500 had negative returns. So the only sectors that had positive returns were the energy sector and the utility sector. The rest of the sectors had negative returns, and I think you guys now know why. So let's look at the chart, or rather the list. So I hope you guys can see my screen. So the S&P 500 index had a negative return of negative 19.44, and the S&P 500 index, for those who don't know, is the benchmark stock market index of the US stock market. So the S&P 500 has the 500 largest companies in the US, and it's a weighted average of the 500 largest companies in the US stock market. It's used as a benchmark index of the general health of the US stock market, and that's why we use it as a key index to look at how the US stock market performed. So the S&P 500 has 11 sectors, and as you guys can see on the screen, this is how the 11 sectors performed in 2022. And basically, from what we've talked about, you can see these two sectors performed well. So we have the S&P 500 energy sector, we have the S&P 500 utilities sector. So the energy sector had a return of 64.56%, and the utilities sector had a return of positive 1.57%. Okay, so I want you guys to really be keen on the four sectors at the top. There's something I want to show you, I want to mention to you. So look at the top performing sector. We have the energy sector. Look at the second best performing sector. We have the utility sector. Look at the third best performing sector. We have the consumer defensive sector. And look at the fourth best performing sector. We have the healthcare sector. Okay. Take note of that, because I'm going to come back to that point and expand more on that. Okay. So talking about energy stocks, so during a high inflation environment, one of the category of stocks which would be considered inflation resistant stocks would be the energy stocks. So here's a list of the top energy stocks in 2022. So we have Occidental with a return of about 17.4%. We have Hescorp, Marathon, ExxonMobil, S&P, APA, Marathon, and ConocoPhillips. Okay, so I think I'll send this on your group, so don't worry about the whole data. So I'll send it to your group. Okay, so which other category of stocks would be considered good to invest in during a high inflation environment? And we're talking about how do you need to structure your portfolio to adapt to the various situation or other economic conditions or situations that we have. So we're talking about a situation where in 2022, 2023, we have had high inflation. So how do you structure your portfolio? We've talked about energy stocks. Okay, so let's talk about other good options to invest in during high inflation. So we have consumer defensive stocks. And when I talk about consumer defensive stocks, let me differentiate between, we have two categories. We have consumer defensive and we have consumer cyclical stocks, okay? So consumer discretionary stocks. So consumer defensive stocks, these are stocks that are composed of goods that consumers will use despite the economic condition we are in. So most food most food products, companies that produce food products would be considered consumer defensive stocks, because no matter the situation in the economy, you still need to have food products. Okay. When it comes to consumer, the other category, consumer cyclical, or rather consumer discretionary products, these are stocks that tend to move with the health of the economy. So if the economy is performing well, they tend to perform well. And that's why they're called consumer cyclical stocks. These are I would basically call them like luxury goods, like basically things that you don't need, but you use them if you can afford, or rather if you're in a good economic state to pardon me for that, financial state to buy the products. And so let me talk about the consumer defensive stock. So consumer defensive stocks are usually a good option in such an environment. We also have financial companies. This is because financial companies will benefit in the short term when interest rates are high because of the debt, because they offer debt. Okay. We also have utility stocks. So we have these three categories. We have consumer defensive stocks, we have financial stocks, and we have utility stocks, have historically held well during high inflation. So let me give you some examples. When you look at consumer defensive stocks, we have the best performing company in this category is the Lamb Weston Holdings with a return of 41.8%. We also had Acadaniels, we have Campbell, we had General Mills, Conagra, and Molson. So don't mind about the stocks. Let's look at the utility stocks. We had Procter & Gamble, we had Sempra Energy, we had Centerpoint, we had American Electric Power, and we have Exelon Corp. So when it comes to utilities, when you talk about utilities, we're talking about things that you use on a daily basis, like power. So that's why you can see companies like the American Electric Power in. Okay. Let me talk about, let's look at the financial stocks 2022. You can take screenshots on your laptop, okay, or your phone. So we had the Arc Capital Group, the return of 41.62%. We had the Barclay Corp with 33.52%, Globe Life 28.05%. The rest, you take a screenshot and go through them later. Okay. So how do you respond to inflation? As I mentioned earlier, inflation should cause investors to consider, or rather reconsider, both the investing style and the specific type of securities in their portfolios. So during high inflation, you need to shift from a more growth type investing to a more value type investing. And this investment style tends to do relatively well during inflation, because unlike growth investing, value investing entails the practice of identifying and buying stocks whose intrinsic value, as determined by fundamental analysis, is significantly lagging below their share price. So basically, you are looking for bargains in the market. Okay. So generally, to identify value stocks, they will tend to have a low price to earnings ratio and a strong free cash flow. Okay. So note that to identify value stocks, these will be stocks generally that have a low PE ratio and a strong free cash flow. And the way you use this data is you need to compare with other companies in the same sector. So if you're looking at a company like Marathon Petroleum, these are let's say you're looking at a company like Valero, let's say Valero Energy. These are company in the energy sector. Okay, so you need to look at what's the PE ratio of other companies in the energy sector, or what's the average PE ratio of other companies in the energy sector. And with that data, then you can determine, does this company or does this stock have a low PE ratio? And then also, does this stock have strong free cash flow compared to other companies in the same sector? So let me have a look at the top US value stocks in 2022. So we have Marathon Petroleum was the highest value stock with a return of 83.49%. And as you can see, it's in the energy sector. We had SLB, we had Valero, we had Cardinal, we had Philip, we had Signa, and you look at the rest, or you can take a screenshot of the screen. Okay. So let's talk about inflation hedges. Besides opting for value investing style, there's several types of securities that make wise inflation hedges. So they include small cap stocks, we have dividend growth, and we have consumer staples, we have financial and energy. Basically, I've mentioned most of them. Okay, so so the only stocks category I think I've not mentioned in I've not put down is the dividend growth. I'll add that the dividend stocks. Okay, so for the consumer staples are the same as consumer defensive stocks. For the financial stocks, we've talked about them. For the energy stocks, we have talked about them. Real estate is another tried and true inflationary hedge. So residential real estate in particular is seen as a haven during inflation. Home construction and building materials are also getting recommended as inflation busters. So please note that to invest in real estate, you don't need to buy actual apartments. You can actually invest in real estate through real estate investment trust, which are popularly known as REITs. These are public companies that own real estate or mortgages and which offer a way to invest in real estate without actually buying properties. And with that, let's look at the top US rates in 2022. Okay, this is based on their 2022 total returns. So we have companies like the Realty Finance Corp with a return of 180.0%. We had the Healthcare Trust, a return of 88.53%. We have Aspen Digital with a return of 65.69%. We had Maxas with a return of 55%, and we had Fibra Hotel with a return of 44.54%. Once again, take a screenshot of your screen and you can go through them later. Okay. Finally, let me talk about the last one. Commodities are also a good option to invest in during inflation. So commodities, we have different types of commodities, but the common ones are gold and oil. So we have commodities like oil, precious metals, natural gas, grain, beef, and coffee, among others. Okay, so investors can direct their portions of portfolios into commodities using futures and option contracts or through exchange traded funds, commonly known as ETFs or mutual funds. Okay, so let me talk about ETFs. So we have ETFs like the gold ETFs, and you guys can go to your HISA app and go to the US ETFs button. When you click on that, you can search for gold ETFs and you'll find several gold ETFs that you guys can invest in. Okay. Before I talk about basically how to build a resilient portfolio, let me talk about how to invest in gold. And before that, let me explain the relationship between interest rates, the US dollar, and gold prices. As you guys, as I had mentioned to you guys on our WhatsApp group and on previous webinars, in 2022, we had a surge of the US dollar. So basically, the US dollar was rising in comparison to other currencies. And the way you look at this, we have a chart called the dollar index, and its ticker symbol is usually DXY. If you want to look at that, just search DXY, the dollar index. And so if you look at the dollar index was actually rising for the most part of 2022. So what's the relationship between the price of gold and the US dollar? So the price of gold is usually generally inversely related to the value of the US dollar. Okay. So please know that the price of gold is inversely related to the value of the USD. This is because gold is dollar denominated. So this means that a strong US dollar, like in 2022, tends to push the price of gold lower, while on the other hand, a weak US dollar will tend to drive the price of gold higher because of increasing demand. Basically because more gold can be purchased when the dollar is weaker, or rather the dollar price metal becomes cheaper for buyers who are holding other currencies. Okay, so I've talked about the relationship between gold and the US dollar. Let me now talk about interest rates. So lower interest rates will tend to be beneficial for gold because they decrease, know that they decrease the opportunity cost of holding gold. Okay, so what happens when the Federal Reserve lowers interest rates is that when we have lower interest rates, we're going to see a weaker US dollar. And that's why if you guys have been listening in on what's happening in the market, guys, most investors are anticipating that the more we anticipate lower interest rates, we're going to see a lower or rather a weaker US dollar. So why does the dollar weaken? The US dollar will weaken because foreign investment capital will flee the US as investors look for other markets that are offering high yield returns on bonds and other interest rate products. Okay, remember when you started the webinar, I told you guys the reason why investors will shift their portfolio to hold more bonds when when the Federal Reserve is raising interest rates is because the bonds will tend to be perceived to have a more risk to reward ratio compared to stocks when the Federal Reserve is raising interest rates. And basically, generally, because bonds are sort of a debt asset, when interest rates are higher, generally the returns will be higher for the person giving out the debt, which in this case is investors who are loaning the government. So generally, with that in mind, when the Federal Reserve now starts reducing the interest rates, what will happen is that the foreign investment capital will flee the US because they have now started reducing the interest rates to go to look for other markets where they can get higher yield returns on bonds and other interest rate products. And let me just throw in something there, although I don't want to talk about it today. This week, you guys heard about the BOJ decision. Basically, for the longest time, the Bank of Japan has been sort of having the yield curve control policy. And what's happening is investors sort of the bond investors have been pushing the Bank of Japan to get rid of the yield curve control policy. And why is it important? This is because if the yield curve control policy is removed or rather done away with by the Bank of Japan, we're going to see more investment capital going back home because now there's no cap to the yield curve and the interest rates can go on a free flow and investors will be able to make more money or rather more returns on bonds. And that's why the BOJ decision has been important or rather matters. But don't focus on that. That was just an extra thing I decided to add for you guys. So with this in mind, the direction of the US dollar will determine any potential returns of gold in 2023. And as a result, the returns of any gold-related assets, which be it gold ETFs, be it the returns of gold miners or stocks of companies that invest in gold. So I hope you guys by now know what a Fed pivot is, okay? So we anticipate a Fed pivot at some point in 2023, or even 2024, but most likely 2023, putting an end to quantitative tightening, what I've been talking about, as inflation continues to ease. Sorry for that. So this could lead to more dollar weakness and hence potential price upside for gold, okay? So how do we invest in gold, knowing this? So there are several ways to invest in gold. The first two ways, I'm not going to focus on them because we don't offer them on HISA. So the first one is to buy gold bars and coins. I'll not talk about that. Number two is to use gold futures or rather derivatives to speculate on the price of gold rising or falling, which then allows you to take advantage of leverage and margins. I'll not talk about that. So if you don't want the hassle of owning physical gold or dealing with the fast pace of margin requirements in the futures market, then a great alternative will be buying an ETF, that's an exchange traded fund, that tracks the price of gold. So the two largest gold ETFs that track gold, we have the SPDR gold shares and its ticker symbol is GLD. And we have the iShares Gold Trust ETF, and its ticker symbol is IAU. Basically, the goal of these ETFs is usually to match the price performance of gold minus all the annual expense ratio that you might need to cover in your investment. Yeah, and these ETFs will generally tend to be more liquid than physical gold. So please take note of that as you invest due to the risk factor. Okay. Another way to take advantage of rising gold prices is to own gold mining stocks. So gold mining stocks, the biggest gold mining company is called Newmont Corporation, and its ticker symbol is NEM. And the stock, as of the time I wrote this article on gold, the stock was up 9.2 year to date. So as you can see, the company has been performing well. And finally, if you don't want to dig much into individual gold companies, then you can invest in ETFs that own gold mining stocks. So let me give you some examples of ETFs that hold my gold mining stocks. So we have the VanEck Vectors Gold Miners ETF, the VanEck Vectors Junior Gold Miners ETF, and we have the iShares MSCI Global Gold Miners ETF. Please note that you can find all these ETFs on HISA, so make some effort to look for them and just observe how they perform and what they do. Okay, so the advantage of these ETFs is that they will give you the safety that comes with diversification. Okay, so I think I've talked for so long. Let me conclude by just giving you sort of some tips on how to build a resilient portfolio. So in terms, uh, generally in your investment life, you'll tend, at one point you'll be in the markets in a time where we have high inflation and high interest rates. So it's important to have a few tips in mind on how to construct a strong portfolio during such times. So what are some of the tips you need to be able to stay resilient in such a market? Okay, so the first tip is you need to diversify your holdings across different asset classes. Okay, so this will ensure that you have other investments to rely on if one sector is struggling. And one of the best ways to diversify your investment is to invest in ETFs, let's say like the index ETFs, so that you're investing in the general stock market as compared to, let's say, a person who is investing in individual stocks who might actually face the downside effect of a single stock falling. Okay, so one of the major ways of diversifying is investing in ETFs. Another way is to invest in different sectors. Don't just invest in one sector, investing in stocks in one sector. You need to diversify between different sectors. So you can hold some stocks in utilities, hold some stocks in the consumer defensive sector, and hold some stocks in the financial sector. Another tip is to choose quality over quantity. It's better to have small number of high quality stocks than many low quality ones. And how do I identify quality stocks? So for quality stocks, you need to look for stocks with very strong balance sheets. Okay, that's one thing to look for when identifying quality stocks. Go for stocks with strong balance sheets. Go for stocks that offer consistent dividends, okay, and go for stocks with a competitive edge or stocks with a market dominance in the sector they operate in. Okay, so let me mention that again. Go for stocks with strong balance sheets, go for stocks with a competitive edge, and go for stocks that pay consistent dividends. Okay, another thing is to understand your risk profile. So it's important to understand how comfortable you are with risk. When you take on more risk than you are comfortable with, you sort of tend to set yourself up to lose more money and risk making emotional decisions like selling out of the market, which will have considerable negative consequences on your long-term well-being. There's a common saying in the stock market, you only lose when you sell. So when you take a huge amount of risk, when the market is making a correction, you tend to be in an emotional roller coaster because you have taken a huge amount of risk. Please know that the stock market doesn't move in a straight line. The stock market will move up, have a correction to the downside, move up, have a correction to the downside. And that's why it's important to have a portfolio that's not so risky, or a portfolio that's in line with your risk appetite. Okay. Another thing is to know your investing goals. So knowing why you're investing will help you to get through a falling market. This is often measured in time, short term, long term. So for a person who is investing in long-term stocks, generally you need to have in mind that you're going to experience several corrections along the way. So there's no way the stock will move upwards all the time. So in your investment journey, you need to have that in mind, that at some point I'll experience a correction, but it will not have an impact on how I view my portfolio, because I know this is how the market will perform, and I need to be patient along the way, especially for long-term investors. Most of them will tend to go for value stocks. And so for value stocks, these are stocks that are going sort of like at a bargain in the market. So we'll have to be patient enough to wait for the market to recognize the value of this stock, and eventually the stock to rise. Okay. Another tip is to monitor your portfolio regularly and rebalance when necessary, which will help you stay on track and avoid making impulsive decisions. So when you talk about monitoring your portfolio, the way to monitor your portfolio is to use the tips I've given you as you started the webinar. You need to sort of identify what's happening in the markets right now and how best should I structure my portfolio in such an environment. So if we're seeing an environment where we're seeing a lot of inflation, then you need to know I need to restructure my portfolio so that I reduce the number of growth stocks that I have and sort of increase the number of value stocks that I have, increase the number of energy stocks that I have. Basically take a more defensive approach in your investment. Okay. And finally, you need to have cash on hand. And this is important. They always say that cash is king. It's always wise to have a small allocation of cash to invest in the market when it falls. This is important because when the market falls, this basically allows you to take advantage of stocks that are going at a bargain, basically what Warren Buffett does. Yeah. So you need to have cash in hand to take advantage of such moments in the stock market. Let's say we had the stock market crash in 2008, and most guys who bought shares at that time, most companies were going at a bargain price, were able to make huge profits after that because they were able to buy at very low prices, what you call discounted prices. Basically, having cash on hand allows you to buy stocks on sale and enjoy a significant gain when the uptrend resumes, or commonly known as buying the dip. Okay. And as I finish, I think I need to clarify more on that. Guys, when I talk about buying the dip, it's important to know that when buying the dip doesn't mean chasing the stock price. So you don't need to a stock that has been consistently falling, and then you are trying to buy as it falls in the name of buying the dip. You need to first wait for the stock to bottom, and then when stock forms a bottom and starts sort of rising up and gaining some momentum, upwards momentum, then you can hop on the stock and enjoy the profits as the company rises. So don't try to chase the price of a falling stock. I think that's it from me, unless you guys have questions. Raise your hand if you have any question, or you can type on the Q&A section. Okay, I think that's it from me. Okay, thank you so much for attending the webinar. I hope you guys have learned a lot. Let me get remarks from one of the person who attended. Let me get remarks from Fred, and then we can close the webinar. We'll have an Instagram live today at 7. I'll be live with Gertrude from HISAM. I hope you guys will make time to attend, and we can talk more about what we have discussed, factors that affect the stock market. Okay, let me get some remarks from Fred, and then we can call it a day.
Anthony, thanks for the good presentation. It was really eye-opening since I've just been following you guys like 2 months, so I'm really a novice in this. Actually, I would like where, if possible, you can share the document that you just presented today for a better personal review of this one.
Okay.
Yeah. Then I heard you talked about WhatsApp group.
Okay.
I believe a lot in that.
Okay, no worries.
Yeah, so I don't know, maybe you can share a link to that group.
I think what I can do, let me type my number on the chat, and then you can text me so that I can add you.
Okay, that's fine.
Have you seen it?
Yeah.
Yeah, perfect. Okay, so I'll add you, and then I'll send the document on the WhatsApp group.
Okay.
So have an amazing day, and you can join me later in the evening at 7 p.m. on Instagram. Thank you so much, and have an amazing time.
You too.